This is our Forex blog for August 1st, 2014. These are our currency indexes, which let you see visually what each currency is doing as a chart, just like the S&P 500, NASDAQ, and Dow, and other indexes do with stocks. Before I show you that, let's just go over some of our Forex signal results. It was a very active day. You can see a small win right here in comparison to the risk. And really that's the key to trading. Small risk, huge win on there. Small risk, another huge win. Small risk, very giant win. Small risk, another nice win. Small risk, very tiny win. It does look like every single trade worked on Friday. And one thing to keep in mind is I like to compare and evaluate signals based on the winning percentage, how big the wins are to the losses. But if you look at the day's range, about 45 to 80, that's about a 65 pip distance from high to low. If you add up these wins, 10, 20, 25, we're at 35 pips already, 45, 55, 65, 75, 80, 90, 100, 105. Even though the market's high to low was only 60, 65 pips, it made over 100 pips during the day. Now that's unheard of, and it's one of the reasons why I like day trading rather than swing trading. If you have a loss, like this one pretty much right here, very tiny, this is a small win. If you have a loss, you can get it back usually in the same day. Whereas if you have swing trading or longer term trading, if you have a series of 2 or 3 losses in a row, which does happen, it might take you days, weeks, or even months to get your losses back. So it's much more frustrating for me trading longer term. That's the main reason I don't. And as you can see here, with a distance of only 65 pips, making over 100 pips, it's much more profitable than day trading or swing trading. If you bought the low and rode it all the way high, which very few people can ever do, you made less pips than my system did. And equally as important as finding good trades, it's avoiding the markets when they're choppy. If you look at this one, it's just kind of, lots of wicks on these bars. Here's a trade here that's a loser, right? Here's your risk. You ultimately lost less than that, right? So not all of your initial risks is what you're going to lose when you're wrong. Very rarely does it hit the full stop out point. It tends to go a little bit your way most of the time, which brings the stop down and you lose less than what your original risk is. But during all this choppy phase here, we avoided it and we got short right here, and it caught a pretty nice win, which got back all the loss here, and then we ended the day short here, and it's obviously a Friday, so you'd want to close your positions manually. But you want to avoid trading when the market's just ugly and isn't moving that much and has very choppy bars that don't have fully formed bars. Where with range bars, you want to see the bar open and close at an extreme on each bar. Here's the pound dollar, which did very well yesterday, and you can see this is what a good range bar looks like. All green. There's no wicks on this move up here. Small risk, huge win. Small risk, very tiny win. Here's 2 losses, right? You have a tiny loss here, and you have a tiny loss here. Some of those 2 losses was gotten back with this, well, not much, maybe 2 pip win here, and then you have a small risk here, big win. This one win gets rid of these 2 losses, and you have this huge win, tiny win here, and you can see small risk, very tiny win, small risk, big win, tiny risk, pretty much break even, maybe 2 pips, and again a nice sell to the low where you would have made 5 pips. Again, the key to trading is small losses, big wins. Try to take as many high probability trades as you can. Our statistical tools are exceptionally good. In fact, one of the reasons for this sell right here, you might say, well, why'd you sell this after so many bars up down like this? Well, it's our trend reversal signal. It gave, and I'll put this white so you can see it, it gave a notice that the market's likely to fall, and pretty much right on that bar. As you can see, that white dot. Now, I don't take every trade at these white dots, but you can see most of the time price reverses soon after, soon after, soon after. If other criteria, and this trade probably has about 15 or 20 rules, if all those other rules apply and these trend reversal signals hit, we give a sell signal. So, accuracy is extremely important to me, mainly because if I have maybe 2, 3 losing trades in a row, I start to bet bigger. So I can't afford a series of 5 losing trades or I'll lose a fortune. I start to get very aggressive and bet bigger amounts to try to get back losses in my automated trading systems. So accuracy is exceptionally important. I don't even care if the system's 50-50 as long as it doesn't have a string of 3 to 5 losers in a row. Then it becomes a nightmare situation for me. So that's why accuracy is utmost importance, and we have about 552 patterns as of right now, and I add about 8 to 15 every day, and I fix the older patterns which I was much less strict on. It's very hard to create a system that's just a simple system and have it make money. So I've decided to, for each new pattern, find 15 to 35 rules that all have to apply. And with 552 patterns, you can see in the euro yen the other day there's only 3 trades. Because each pattern is exceptionally strict, very rigid, and I do not want to have multiple losses in a row. That is the worst case scenario for me, and that's why I'm designing it in a way that, if you do have a loss or two, more than likely the next trade is going to work.